Hi, welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week, and I'm delighted to welcome Steve Webb, ex-pensions minister and partner at LCP, to the show. Welcome, Steve.
Thanks, Charlotte. Nice to be with you.
Do tell us, what is your news story of the week?
Well, there's only one it could possibly be. It was I was thinking, like, whether it's from a chrysalis to a moth to a butterfly or something, the Pension Schemes Bill has become the Pension Schemes Act, or as the FT put it, evil government ministers, I think was implicit, evil government ministers have given power to force pension companies how to invest. I think that was the headline, more or less.
Yes, the evil bit was probably in the subtext that you had to squint at in order to see. And tell us, why is that your news story of the week, given that isn't the world's most obvious question ever?
Well, partly it's been a long time coming, hasn't it? I mean, I was struck when the election happened in July 2024 and the new government came in, and it felt like, everything was going to be very different. But in pensions, an awful lot was very much the same. So a lot of the stuff that's in the Act started under the previous government and has been years in the making, the value for money stuff, some of the DB surplus extraction and so on. But of course, the thing that was new in the bill was mandation, as it's called. So the power for the government in certain circumstances to tell pension schemes how to invest. And the House of Lords did a good job in the final days and indeed hours of the bill going through. And we can probably talk in a second about what exactly they did, but essentially they restricted and constrained the power, but they didn't take it out.
Yes, I know that there are other news editors of organisations that were sort of pulling their hair out because they would just say it was backwards and forwards, ping-ponging. And Nick Reeve, pensions expert, said, we are running out of pictures of the House of Westminster to use for this news story because it keeps going on and on and on. And so there were a lot of changes. So do you want to talk through with us, Steve, just what mandation powers there are and what there aren't? Because I think there's a lot of confusion in the industry about what the government will and will not be able to do once this act actually becomes a piece of legislation.
Yeah. So the key thing is that when the bill started, the power to sort of tell pension schemes how to invest was pretty vague. And so one of the things the House of Lords has done is required the legislation, actually what in the jargon on the face of the bill, it actually says in the law what this can deal with. So if I give you the 6 things that the government can tell people to invest in, it's private equity, venture capital, private credit, interest in land, infrastructure, and other unlisted equity securities. So those are the only things, I'm saying only in quotes there, the only things the government can specify. That's the first thing. The second thing is that the 10% and 5% targets in the Mansion House Accord are in the bill. So this is by 2030, the main scale default fund has to be 10% in private markets, 5% in the UK. So that's in the bill. And then the third big change is that there is now a sort of a hurdle. So there's a date, 2028. None of this can happen before 2028. But then a set of processes that has to be gone through before the power can be invoked. And a couple of them are quite novel. So one is the pensions regulator, brackets appointed by the government, close brackets. The pensions regulator and the FCA will have to produce a report judging whether competition is causing, for example, master trusts to underinvest in private markets. So the government's narrative has been employers choose master trusts on the basis of price, private markets are more expensive, nobody wants to go it alone, so they're all terrified to invest in private markets, even if this would be good for their members, because they're frightened of competition. So the FCA and TPR will report on that. The Secretary of State then forms a judgment taking account of this report, though not bound by it, taking account of it, as to whether there are any other barriers as to why schemes aren't investing in this way, particularly in the UK, and whether the Secretary of State, him or herself, has done enough to address those barriers, because you remember the Mansion House Accord isn't unconditional. The signatories said, provided the government does its bit, so the government will have to think it's done its bit. And then even after all of that, if this goes through, the Master Trust will be able to appeal and say, look, we don't think doing what you're making us do is in the members' interests. And then the pensions regulator has got to decide whether that's justifiable or not. So it's pretty tortuous. There's lots of sort of safety valves, but I still think a determined government could steamroller this through.
Okay, well, that's interesting. It's great to get that level of detail, because I know there has been sort of a lot of confusion and discussion, and it's been just hard keeping up with all of the changes as they've gone through the House, and when the bill finally became an act. But that's kind of not where we are. It's not complete yet, is it? So if you could just give us policy non-wonks a quick lesson in what happens now in terms of acts becoming legislation and all the rest of it.
That's right. So it becomes an act when the king, who appeared to have been in America at the time, but still have managed somehow to give royal assent to the bill. So it is an act of parliament, but then it's an enormous act of parliament, and different bits come into force at different times. That's the first thing. So they have what are called commencement dates, and the commencement date is not the date of royal assent, and it's not the same day for everything. It can be different for different bits. So you have to go through the bit you're interested in and work out what the commencement date is for that. And that's the first thing. The second thing is that acts of parliament, what are called primary legislation, give you an overarching power, but one of the powers they often give you is to do more detailed legislation, statutory instruments, regulations, secondary legislation. It's the same thing. And what this does is, if you want to change something in law, you don't always want a brand new act of parliament. Sometimes you just want to knock through a quick statutory instrument that can be done quickly. So detail tends to be done in this secondary level. These statutory instruments are sometimes done on the basis of a new consultation. So there might be more rounds of consultation, there might be regulator guidance, all this kind of stuff. So if, the pensions regulator, say on DB surplus extraction, there'll be further regulations and there'll be TPR guidance, and all of the stuff won't actually happen till all of that has happened as well.
Mm-hmm. I mean, and there is so much in the bill, in the act, as you mentioned. I've got so used to calling it bill, I'm going to have to really have to really work to think about it as an act now, but it's been going on for so long. There's so much in there, and I know with my conversations that I've had with the industry, all the different bits that in the act, that there's still a lot of things that need to be sorted out, and people can't really make the changes yet because they haven't really got enough detail on the legislation, the regulation, and what going forward. I think something else that's really interesting as well, we've got this enormous act stuffed through all of these different things covering the whole gamut of pensions in the UK. And at the same time, we've got a review of the state pension age going on, and yet the state pension age has not been included in this act. And if we go back to that hallowed Pensions Commission, the first one at the start of the millennia, chaired by Adair Turner, that, he fought against Brown and Blair in order to get something about the state pension age into that piece of legislation and commission work, but it's been obviously left out this time. Why is that?
Yes, it's not a coincidence that the Pension Schemes Act 2026 is called the Pension Schemes Act and not the Pensions Act, because the title of these bills, so that's what's called the short title, and then there will be a longer title, a bill to enable ... which is like 2 sentences. They determine the scope of the bill, what's in and what's not in. And if it was just called a Pensions Act and wasn't very narrow, state pension amendments like on the WASPI Women's State Pension Campaign would be in scope. And, if you're a relatively unpopular, at time of recording, government, and there was a chance for a backbencher to table an amendment saying that the WASPI women should get 10 billion quid or something, it would be incredibly hard to win, for the government to win that vote and fight that proposition. And they've been frightened to have anything to do with state pensions. The last legislation that was called a Pensions Act was over 10 years ago. However, as you say, Charlotte, we have a pensions age review, state pension age review on the go at the moment. That will feed into the pensions review, now led by Jeannie Drake, and it seems reasonable to think that they will have something to say on state pension age, and it would be odd not to then legislate for that. So we could get a Pensions Act or Pensions Bill in the remainder of this Parliament, because just because we're all tired and we've just had one doesn't mean there isn't another one coming down the track.
Yeah,
and sorry, Charlotte, just if I may on timing, it's worth saying to people that we thought we knew when everything was going to happen, because the DWP helpfully published a roadmap of dates when stuff would happen. We now think that's going to be reissued and it's going to involve some slippage. So some of the dates we thought we were working to, we think now will slip.
Things take longer than you thought.
Who knew?
Who knew, right? Every human being, every day. Oh no, I could do this much today. So I mean, with the state pension age, though, is there, I mean, WASPI aside, that kind of particular massive can of worms aside, is there much that really needs to be done around the state pension? Because we have this kind of loose understanding, I think, and maybe very loose understanding that state pension age is going to keep track with longevity. And there are still debates to be had within that arena, isn't there? Because depending on what you've done all your life, it may be fairer or unfairer for the state pension age to increase, in that and for that state, for different professions, it's harder to keep working for longer. Like if you've been a labourer all of your life, expecting you to carry on labouring into your 70s is unrealistic. Whereas, people like you and I who sit in front of a computer all day, we can happily tap away at a keyboard.
I've had a hard life, Charlotte.
Well, you've been a minister too, so yes.
Well, yes.
So is there kind of like flexibility around that? Is that where we need to have the debate? And I know we also had an announcement last week from the Tony Blair Institute about how we could keep track with all of that.
It's something that, so we're on the third review of the state pension age, and each of the previous two looked at these kind of issues. The sort of, if you just crudely raise state pension age, then people in Blackpool and people in Glasgow have a higher chance of not getting there at all. And if they do get there, it's a bigger chunk of their pension disappearing when you raise the pension age. The Tony Blair Institute, as you mentioned, put out a report with a pretty radical proposal. I mean, they got headlines because they said the triple lock on the pension should go, but everybody's saying that. What's novel about what they said is that everybody, you and I, should have a unique state pension age based on our National Health Service records and a slightly Orwellian forecast from the state of when we'll die. And then we would get a pension age 20 years before that, so T minus 20 and counting kind of thing. And, it's the sort of thing that looks probably very clever on a whiteboard in a think tank, but wouldn't survive contact with the real world, which is not to say these aren't important issues. So Labour in the past has been very negative about state pension age rises. So at one stage they were saying the move to 67, which is happening as we speak. We are moving from 66 to 67, shouldn't happen. Well, they stopped saying that. The big unknown at the moment is 68, currently scheduled for the mid-2040s. The reason we need this review now is if that's going to be brought forward to the late 2030s and we're going to give people 10 years notice, we have to have legislated by the late 2020s, which ain't that far off. So I think that's the burning platform, if you like. If they want to bring that date forward, as I'm sure they do, they need to get on with legislating for the next move.
It'll be interesting to see what happens there. So as we mentioned, there's an awful lot in the Pension Schemes Act, and we could spend much more than half an hour talking about all of it, but we are the Professional Investment Podcast. So are there particular areas within that Act that you think are going to have interesting investment implications, ones that you want to highlight?
Yeah, I mean, there are so many, but just to pick a handful. So one is I think unalloyed good news is what's called in the jargon a contractual override for group personal pensions. So lots of huge sums of money, a third of $1 trillion or something, are sitting in contract-based pension arrangements, group personal pensions, group stakeholder, and that kind of thing. And a good chunk of that, tens of billions, is in very old stuff. Yeah. When investments were less sophisticated, charges were higher, all that. And until now, it's been really hard, even for providers. And read the newspapers and you think providers are just evil and want to make as much money as they can. But actually, the providers themselves would quite like to get the money out of this often poorly performing, high cost, on old computer systems, all that stuff. And they haven't been able to do it because contract-based provision was person by person. I have a contract, you have a contract, and they couldn't be overridden. What the law will allow to happen in certain circumstances is the providers say, look, en bloc, we're going to move this money either to a shiny new group personal pension or to a master trust. And tens of billions will flow. So a small number of providers have most of the money. So household name providers you can think of with big back books will start moving tens of billions. Suddenly a master trust that looked quite small might suddenly go past the 25 billion threshold overnight, potentially. Take a few years to happen overnight, if you see what I mean, but at a stroke. So that will be a significant shift in how money's invested. I think on the DB side, I mean, the surplus extraction stuff will have investment implications because obviously if you're heading towards buyout, you're de-risking, you don't try and take all the risk off the table and you want to pass it to an insurer, that's one thing. But actually, if you can run on, cover your liabilities in a fairly low dependency way, and then you've got some spare cash, you have a bit more fun with that. I mean, DB it's relative what having a bit more fun constitutes in investment terms, but a bit more growth than you might have expected to see. Maybe not long-term illiquid, because at some point you're still going to buy out, but a bit more interesting growth assets on the DB side. So that will be a significant shift as well.
Although, as we've discussed before, there are some other sort of like issues around that, in that that everybody has the surplus and nobody knows how to spend it. We've discussed before, and there are different things holding people back from, whether that's the company, the sponsor, and the sponsoring company, the trustees, or even the members themselves. And there are some other issues that are going to have to be resolved around accountancy and the like, isn't there?
There is, and one of the other things in the Pension Schemes Act is the ability to override scheme rules, because the risk was the government pulls this lever of surplus extraction and discover it's not attached to anything because 5,000 sets of scheme rules say something different. So trustees will, in consultation, be able to get the scheme rules changed if that's a barrier. But as you say, it is literally the case that each of nearly 5,000 DB schemes is unique. They've got their own history, their own funding position, their own attitude from the sponsor, strength of sponsor, attitudes of the trustees, scheme rules, all that stuff, which makes it so fascinating and makes it hard to generalise. But I do think we will see, now that this is legislation and we'll get further detail, a set of larger, well-funded schemes running on, using surplus creatively and sharing the proceeds. So we will see enhancements to DB benefits, possibly lump sums to DB members. We will see more of the sort of thing that at LCP we've been working on, getting DB surplus through to a master trust. That's quite innovative how you do that, and that's going to start to happen more. And the sponsor getting some, which is what the government wants, money in the hands of what we might loosely call British business, though an awful lot of these companies aren't terribly British.
I wonder if one other area I might highlight as well, and that's the value for money framework. And we've seen a bit of a cautionary tale of what's happened in Australia with value for money. I mean, I understand the idea that you want something that's going to be able to persuade you, give you a benchmark with which to measure all of these different pension providers, and to choose one and to move away from, just cost as a metric, which has kind of kept the investment universe very small. But as my mother would say to me, be careful what you wish for.
Very wise woman, your mother.
She didn't make it to 90 without getting some wisdom along the way. But so there is a danger, and we've got this sort of this weird traffic light system where we have 4 sets of traffic light rather than 3. Is there a danger that, with a value for money benchmark, that you could actually stifle investment innovation rather than encouraging it? What do you think the investment implications are of value for money? What does the government need to think about as it works its way through secondary legislation and carries on tweaking the framework?
Yes, I think it's a very real risk. There are 2 things in the Act that could stifle innovation. One is just to mention the mega fund stuff that says you can't play if you're not 25 billion, with a few exceptions. And although there's reference to an innovation pathway and you can be a bit smaller for a bit if you do something clever, the reality of the market is if we roll forward to the mid-2030s and we've got fewer than 150 billion mega funds, the idea that you have a bright idea and can enter this market is for the birds, frankly. So I'm very sceptical about innovation through that route. And again, on league tables and all of that, I'm really keen on this idea of a soft launch. So rather than, we go out there all guns blazing, everything gets published, everyone gets put in a league table that's in your Sunday newspaper and your scheme's at the bottom and they're amber rated and they basically have to shut, which could be pretty destructive. I think a soft launch of working out, well, what does the data tell us? Are we comparing like with like? How do we communicate to this people? When do we do that? Is really important, because the danger is nobody wants to stand out from the pack, okay, it'd be lovely to be dark green, but everybody's going to be okay if they're light green because that's pretty good. But everyone's going to be terrified of being amber or red. So the idea that you might think, well, we've got some brilliant expert investment specialists, they're going to invest in this wild new asset class, which could be fantastic for members, but we might have a few rocky years. That's not going to get on the starting blocks, because the rocky year, if these VFM assessments done every year, then what's the new data you've got compared with the last time you did it? It's the last 12 months return. So, we pretend that we want investment people to focus on the 30 to 50 year time horizon, but we're going to assess them every 12 months. So again, there's going to be a massive incentive not to do anything particularly volatile, anything risky, anything different. And, I've used this phrase that we risk having a slightly grey blancmange Someone told me nobody under 60 knows what blancmange is anymore. But, there's kind of slightly mushy, everyone pretty much the same. No one wants to stand out from the pack. And that would be a real shame and not good for members.
Well, I mean, there's a lot of sort of inherent contradictions in the Pension Scheme Act as well. I mean, the problem with making everybody bigger and bigger and bigger is it becomes harder to invest in something smaller and smaller and smaller. And the UK economy is relatively small, and UK venture capital is relatively small. But it's fair to say that most pension schemes don't want to invest anything less than 2% or 5% of their portfolio. And that's, if you're getting bigger, that's not going to be anything shy of £1 billion. And then what are you going to do if it's only a 500? There is this complexity within it, isn't there? And I think there are obvious economies of scale when you invest, but we kind of forget that there are diseconomies of scale as well. I mean, everybody who runs a fund knows this. That's why funds are gated. That's why funds for very specific investments tend to be very small and quite heavily policed, because you do get to a point where you can't put any more money in it. Now, that might not matter if you're investing in World MSCI, but it becomes much harder if you want to do all this innovative specialist stuff, and if you want to do stuff that's about energy transition and green energy and even natural capital and the like. All of that becomes much more complicated in a bigger is better world, doesn't it?
Indeed, and I think people underestimate the difficulties of scaling rapidly, because we're sitting here in 2026. None of the providers virtually none of the signatories of the Mansion House Accord are anywhere near the 10% target by 2030, and actually. Bear in mind, they've got vast amounts of money flowing in every year, billions flowing in from new contributions every year. So they've got to add that to what they've already got and allocate a set percentage to private markets of some sort. And it turns out that there's easier stuff that people are familiar with, kind of real estate or something like that. But the things the government really wants, as you say, Charlotte, the kind of more venture capital end of things, the private equity, the tech startup, and all of that, is not a fantastically good fit. And I think. Some of the things like the British Business Bank and others are trying to help with this market failure problem, but clustering, bundling some of these investments is going to be key. I think, as you say, it's not worth the due diligence of a huge pension scheme to invest a few million quid in something in Cambridge that's going to change the world. Maybe 100 things in Cambridge that might change the world, but somebody's got to cluster them together.
Yeah. And I mean, it also creates a challenge for those boutique asset managers who might have something really interesting, but just find that they can't get into the institutional space. They're going to have to think cleverly about how they do that. One area, there's lots of areas that we could, even though the Pension Schemes Act is absolutely enormous, there are a few areas that have been left out, and the Pension Scheme Commission is picking up on. And one of those areas, which obviously is close to my heart as somebody who's self-employed, is what we do about self-employed provision. And I know that you and I have talked about this over the years. I think we've talked about it on and off for the last decade at least. So could you talk to us about how, because this is really kind of like, I know, aside from sort of the adequacy question and people really not saving enough into their pensions today, and that being a nettle that people don't want to grasp. And, it goes back to CBI and the like and what happened with the first pension commission. The self-employed is a huge group that isn't currently being covered by auto-enrolment, and it's a sizable minority. I think it's about 15% of the working age population. What should we be doing? How do we solve the problems, and what are the issues that stop us from giving self-employed people pension provision in the same way that an employed person does?
As you say, there's been a long-running sore, really, and the pension coverage amongst the self-employed is shockingly low and falling. I mean, that's pretty shocking, really. Partly because the nature of self-employment has changed. That 20 years ago, if you were self-employed, you perhaps had a business. Your business might even have been your pension. Today, you could be a delivery driver or doing, crafting from home on eBay or Etsy or something. So the nature of self-employment, I think, has changed, and that's partly why there's less retirement provision linked to it. There are some self-employed people who are providing for their retirement in other ways. So it's not just pensions isn't the only thing. It could be property or something, or the business, but they're a minority, I think. And I think the big political barrier has always been the self-employed, almost by definition, no disrespect, are a bolshy bunch. They partly, if they've chosen to be self-employed, it's because they want to be their own boss. They want to do things their own way. They don't like to be told what to do. And then government's coming along. Yeah, I'm told. And governments coming along and forcing them to do stuff, would be very difficult. It has always struck me that the one engagement that the self-employed have, for good or ill, with the system is HMRC, tax returns, etc. We'll park quarterly data feeds and all that sort of stuff for now. But, once a year at least, once a year at least, they are engaging, reporting income and so on. I would use that moment that matters, to default them into some sort of pension saving, and to get them going, I have some sort of incentive, some kicker, some starter. So I would enlist Martin Lewis and get him to write to his 8 million email list and say, look, the government are going to give you free money if you as a self-employed person start a pension when you file your tax return. They will put 500 quid, whatever number, think of a number, 500 quid in. Needn't be a king's ransom. But if it had the effect of getting people started on having a pension, then given that self-employment can have good years and bad years, if you've got a pension and you have a good year, you might think, well, actually, yeah, it's easy for me to put some of that surplus for this year into my pension, rather than, I need to set up a pension and you never get round to doing it. Mm. So a version of auto-enrolment with an opt-out uses the tax system that puts some money from on top of your tax bill, but a modest amount, ideally spread through the year rather than in one big lump. Because again, that's going to work better for self-employed people. That's got to be the answer. I can't think of another answer. But everyone's too terrified of the self-employed saying, we never voted for this.
Yeah, I know. And you're right. The statistics, and I looked it up fairly recently for a talk I was doing for other self-employed people, and it is absolutely terrifying. Like, as employed have got up sort of about 80% coverage. I think the self-employed have dipped down to below 30%, if I remember that correctly.
Well below.
Yeah, so people are just not doing it. So yes, I mean, I don't understand why people would be scared of the self-employed. We're just pussycats, really.
White van man and woman, I believe they're known in the trade.
Yeah, and as you say, the nature of self-employed work has changed. I mean, in the past, there were more men than women because so many people who were self-employed were actually labourers, to go back to a previous discussion we were having about state pension age. So a sort of double whammy for that demographic group in terms of having no self-employed pension provision, and state pension age maybe coming too late for them as well, or being forced to work longer beyond the way their body can actually handle. So there's still stuff to do, isn't there, Steve? We've still got policy to address.
Yeah, and I think the new Pensions Commission has quite a big focus on I think Torsten Bell often says 40% of the working age population isn't saving, or whatever the figure is, and the self-employed are a very big chunk of that group. So I'm sure they will come up with things in that space. Yeah,
it'll be interesting to see how we see the outcome of the Pension Scheme Commission now that we've got the Act progressing and being turned into secondary legislation. Well, I think I'm very, very pleased by how much we've managed to squeeze into this half an hour, and the working title basically has to be everything you wanted to know about the Pension Schemes Act, and we're afraid to ask and see if we can squeeze that into the allotted character limit given by YouTube and Spotify. Thank you so much, Steve, for coming on and explaining everything that we needed to know. It's
a pleasure. We'll have to do a sequel on all the bits we didn't talk about.
I'd be very happy to have you back on the show. Yeah, don't worry, we can have you every series. There's always going to be different policy things to talk about. Listeners, thank you so much for listening. I hope you enjoyed today's podcast and you found it helpful. Make sure you hit that subscribe button so you never miss a future episode of the Professional Investment Podcast. Thank you, Steve, and thanks for listening.